Kia ora and welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Brunskill. I'm a markets reporter at BusinessDesk. For those of you who are new to Shared Lunch, we do these webinars, podcasts every Thursday at lunchtime, alternating between an interview with a company leader and an industry deep dive. BusinessDesk has a special offer for Sharesies investors. If you use the promo code SharedLunch100, you'll get $100 off an annual subscription to BusinessDesk, which is usually $250. The offer only applies to new BusinessDesk subscribers and can only be used once per subscriber and can't be used with any other discounts. But we'd love to see you there. We cover the NZX extensively, so get involved. Before we get started, we have some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Also, a quick reminder, if you have any questions for our guest today, you can submit them through the Ask a Question button, which is down below. Don't leave any questions in the discussion area, as I will surely miss them. Please be kind and respectful to our guest and to your fellow viewers. Otherwise, we will remove you from the webinar. Okay, so today we're joined by Mark Peterson, the CEO of NZX Limited. Welcome, Mark.
Hi, Dan. Nice to meet you, and it's good to be in front of everybody.
It's good to have you on. Hey, Mark, you have been the chief executive of NZX since 2017. You were with the company for about 7 years in total. Before that, you mostly worked for ANZ in a variety of kind of capital markets role. What was it that attracted you to working in the financial markets industry?
Yeah, it's a great question. I'm sort of a maths and science guy. I'm not really an English and history person, so I was always attracted to sort of economics, finance, and I did a economics and finance degree actually from Victoria, and then when I left, I joined it was a company called National Mutual, and I was there for a short time, but quickly ended up at a place called National Bank, and had a really, really enjoyable career through there, and it was through that process that the ANZ acquired the National Bank, and so I spent a bit of time, in the market side. I set up what used to be called National Bank Online Share Trading, and then got involved in capital markets activities, and actually spent a couple of years at First New Zealand Capital, as it was known then, or Jardins as it is now, and then ended up going back to the ANZ to look after a business which was originally called Direct Broking that they'd purchased, and then subsequently was described as NZX Security. So I ran that for about 8 years, and then from there I always sort of thought I could help at the exchange, and joined the exchange, and within probably a little bit less than 18 months found myself leading the business. So it's been great. What do I like about it? It's busy, it's active, it's got a lot of macroeconomic influence. You're really helping connect investors with opportunities, and it's right at the heart of economic growth in many respects. You feel like you're actually really making a difference, or hopefully, if we do it well, make a difference to New Zealand.
Cool. What I'm hoping you can do is help us walk through a basic overview of the business NZX Limited and its different elements. And there's sort of 3 parts that make up the business NZX. So I thought we should start with the main part, the part that people know the best, the share market, the market part, which you sort of refer to as being capital markets. Can you talk us through what is involved in the capital markets and which parts of it NZX runs?
Yeah, no, absolutely. So I think about it a bit like an onion, and the capital markets piece that the exchange runs is right at the centre. And there are a couple of key functions. So we provide the capability for people to put orders, orders on for equity securities or fixed income securities or fund securities. So we allow people to put orders on to buy and sell those securities, and the software there, when the prices match and the volumes match, an order becomes a trade, and a trade then needs to be settled. And it's from there that the trade will drop into what we call a clearing system, which is, again, another piece of software that the exchange operates. And the clearing system effectively creates a mechanism between the brokers that those investors traded through to settle that transaction. You've got two elements to settle, as everybody will know. You've got the cash aspect of it, which the buyer will obviously send the cash to their broker, Sharesies in this instance, and I think the money's already sitting there. And then Sharesies will send that on to the clearinghouse, which is part of the exchange. And in return for sending that cash in, that broker, in this instance Sharesies, if somebody's buying, will receive securities, the actual physical securities themselves. So the clearinghouse settles that cash and stock. And then if you think about that, Sharesies is one of a number of brokers around the place. So we've got the connections of all of those brokers in there for trading and for clearing. And then obviously all of those brokers have their client bases, which are all the investors that trade through them. So we're right at the heart of it. Our brokers are at the next layer out, our participants, and then obviously the investors connect to the brokers. So trading and clearing are two key elements of it, but what also happens is those trades and those activities create information, and that information on the trade, on the trading is actually valuable. So we have a business, if you like, which sells that information back out into the marketplace, and lots of people purchase that, not just participants.
And this is your sort of second division, the data and insights division.
Yeah, well, it's the data and insights. It's the information aspect of capital markets. So we send all that information out because people need to understand, all of that. Those are the sort of three key elements, really. The trading side, the clearing side, the data. But from the other key element of our capital markets business is that we want to try and offer as much product as possible. So we've got a team in our capital markets business which speaks to customers. When I say customers, I'm talking about companies. So those that are listed, they're already listed. So we want to make sure we offer as much value as we can for those companies, and that really comes down to making sure we can help them tell their story to a really broad, audience of investors. And there's a lot of work that's gone into that over the last couple of years to improve it. But also that what we call the capital markets origination team probably spends 60 to 70% of their time actually trying to speak to new prospects, so new companies to come to the market that want to access capital and want to offer their ability for their shareholders to trade. And equity securities is one aspect. The fixed income market, the debt market is the other. So we're already talking to lots of businesses about utilising that as another source of capital funding. And then obviously we've got a range of fund managers. Smartsheets being one of them. We'll get to that. Who want to list funds on our market. So we've got an equity market, a fixed income market, and a fund market. So we want more companies, we want more fixed income products, we want more fund products. And by the time you have more of those, plus the trading, plus the clearing, plus the information, that's the bundle that makes up capital markets primarily.
Cool. And then on top of that, you also have another division run mostly through a subsidiary, Smartshares, which is funds management. And that's actually for NZX, the business, that's the fastest growing division. What do you think is driving the growth in that funds management division? Smartshares has been fantastic, actually. We have a range of services in there. So we have a set of solutions, so we provide, corporate superannuation products out to corporates who want to help their employees save. We provide KiwiSaver solutions, which, can be out through companies as well, or it can actually be directly. You can choose to join that KiwiSaver scheme. And then we've got all these ETFs. So we've got about 35, 36, 37 ETFs, which are listed. But what we do there is we make sure that we've got a good set of ETFs which allow investors to create, well-constructed portfolios, but not so much out of individual stocks, but out of ETF securities. And that's a little bit new. There hasn't been a lot of that. So I think, from our point of view, low cost, passively managed, index tracked, fund funds is a bit of a new thing for the market. It's not such a new thing for offshore. The ETFs have been around a long time, but obviously for New Zealand, it's been a new thing. And it's what I think it does is it means that,
very, very regular, people in New Zealand can get access to those, and Sharesies customers are big users of it. So you can actually create, with a relatively small amount of money, quite a nice diversified portfolio, and it's on a low cost basis. So I think for all of those reasons, Smartshares is actually doing pretty well.
One of the questions I had for you was that, in the past 2 years, about 500,000 Kiwis have joined Sharesies and started investing, largely in the New Zealand market, as well as in the Australian and US ones. How has that sudden influx of retail investors from Sharesies and other platforms, how has that changed or affected the market? What impacts are you seeing?
Oh, it's been a fantastic addition to New Zealand's capital markets. Effectively, we've got a lot more participation, which is great. I think, the Sharesies founders, they talk about, allowing people with $50 the same opportunities as if you've had, $500,000. And it just means more people participate. I guess we did get a bit of tailwind through COVID, where people were locked down and they could, spend some time looking at the markets and thinking about where they might want to invest. I think there's been another couple of sort of macro factors that have helped. Obviously, an interest rate environment that's really low, has meant that, the returns you get on money elsewhere haven't been that brilliant. So that's been a factor. But I think there's just a general enthusiasm to understand capital markets more, and maybe folk that might find housing a little bit hard to reach these days, might be thinking, well, the share market's not a bad place to start. So I think you've got a lot of reasons that people are getting interested, but it's the fact that you've got platforms. They're really easy to use. You've got them on your phone, you've got them on your computer. The access is simple. It's well priced, and it's just been a wonderful addition to the market. A lot more retail activity.
Mm-hmm. And you sort of said one of the reasons why there's been increased trading on the NZX, increased interest, has been the low interest rate environment. That's kind of going away, and we're heading into a fairly volatile time and perhaps a less lucrative time. Do you think, how do you predict that impacting the market, and how should Sharesies investors, I guess, be thinking about that? Do you see trading slowing down?
There's a couple of things, isn't there? So if you come at it from the investor's perspective, you've always got to think about what are the objectives. If you are an investor, what are your objectives? Are you in there for the long term? Are you in there for the short term? And I think if you're in there for the long term, then quite often the best thing to do is actually think and look through some of these periods of volatility, because markets are volatile, quite often. We've got an unusual patch at the moment, I guess, with the European crises. We've also got some economic factors. We're coming out of COVID. It gives it some unique characteristics. However, the principles of being there for the longer term, probably still need to remain. So I think investors need to think about that, think about their objectives, think about the long-term positions. They may want to, just think about different tilts, if you like. So if you had exposure to, offshore markets or local markets, just, take a view on whether you think you should sort of wind back or increase your exposure there. But, but quite often the worst thing to do through periods like this is actually to sell. So you just got to look through, think about it, and then make some calls just off the position that that you choose.
Mm-hmm. It's interesting to hear you talk about the exchange being the onion, at the center of the onion, the piece of infrastructure that makes all of this work. Sometimes people are surprised by this. They don't really expect that piece of infrastructure to be a business. They kind of expect it to be, I don't know, government run, like a road or something. How is it? Is there a short version of the story about how NZX came to be a commercially run and itself listed company?
Yeah, well, we wrote a book, actually. This business was
probably a bit of time for that.
150 years old. Yeah, well, back in 2019, we celebrated 150 years of being in existence. And the very short version is it started in the goldfields, down in Otago. And, I think it was obviously incredibly manual. You had cash and you had a piece of paper, which was an ownership stake in something back then. But the short version, if you accelerate that story, is that there were exchanges in most major cities in New Zealand, so Dunedin, Christchurch, Wellington and Auckland. And you might remember in the 80s, these scenes of brokers, being in these rooms with the blackboards and the women with the chalk, very sort of or times down that you wouldn't might expect, I guess. But and they were shouting at these people with with the prices and the new prices for the different trades, etc. So in that environment, the exchange was actually a mutual society. So it was owned by all of the brokers, and not just the broking entities, the actual individual sort of certified stock agent, stockbrokers. So what they did, though, is in the late 90s, early 2000s, they actually demutualized. So all of a sudden, they turned it into a corporate. They moved out of all of the individual sort of main centres, and then I guess what you ended up having was the emergence of technology. So you didn't need those people writing the prices up with chalk, and the automated trading came, it demutualized, and I think it was about early 2002, 2003, that it actually listed on its own exchange. And then effectively, it is a business. It's a commercial business. It's got a regulatory element to it, which we've hived off into a separate subsidiary with a separate board. But at the end of the day, we make money from, the issuers that we provide services to, and they pay annual listing fees. The participants pay us. There's a trading fee. There's information that we sell. So we earn money, earn revenue, and obviously we've got a team of people to run the systems and perform the operational function. So we pay costs and we make a return.
And Mark, because you are a business, you sort of have competitors, and those competitors, obviously you might have different ones in different sectors, but the sort of the big ones you compete against are other exchanges, whether it's the NASDAQ in the US or the ASX in Australia, even the London Stock Exchange. One complaint you sometimes hear raised is that too many New Zealand companies are choosing to list either on the ASX or go to the NASDAQ because it's a bigger market and there are more equity analysts and more funds being pumped into it. So what are you doing, and what is the exchange doing to make sure that the NZX remains an attractive place for NZ companies to list and have their primary listing?
Well, I think there's a whole range of things, really. So you're right in the sense that our competitors are sometimes other exchanges. I guess the other aspect of our competitive position is that we offer access to capital. That's what we offer, but there are other places you can go and get capital from as well. So private equity firms, you can go and access capital too. So in some respects, they are competing, but in other respects, they can also provide new product, to the market. So, they can be a feeder of product through to the public markets as well. But in terms of, the best thing that we can do in relation to ensuring that we are growing is do the right things really well. So we need to know our clients. We need to understand our issuers, be close to our companies, offer value to those firms. And the best way we can offer value to those firms is help them tell their story to as many investors as possible. And there's a lot of work that's sort of gone on to that. I think the other thing that we can do is make sure that when we're hungry for new product, that we're out there, we're telling our story, we're telling that these prospect companies get the sense that we're an ambitious business. We want to grow. The New Zealand capital markets are incredibly important for New Zealand as well, especially when we climb out of these COVID times. And access to capital is something that's actually a very, very relevant issue for boards and management teams of businesses to be thinking about, because if their traditional sources of capital have been bank funding, or friends and family, or even to some extent private equity, quite often, when you get into tougher times, those doors might not necessarily be as open as much as possible. So, we want to make sure that people understand the value of having access to capital. And we've got lots of examples where businesses in their time of need or they're in their time of opportunity have come back to the market and said, if they've got good trusted relationships with fund managers, can you support us? And COVID times back in early 2020 was a perfect example of it, where a lot of money was raised by existing companies who were on the market to support themselves through those tough times. And we had some really great examples of businesses that actually had growth opportunities through that period as well. And they could come to the market, explain what they were doing, and those investors would support them in that. So, we're just doing a lot around making sure we're close to our companies. They understand the story. We're offering value, and we're working very, very closely with a lot of the investment banking teams, the legal teams, the corporate advisory teams, to make sure all of that ecosystem understands our ambitions. And I think we're making some pretty good progress.
Mm-hmm. there's an interesting tension there because, during the pandemic crisis, the advantage of listed companies was hugely on display, where they could raise capital and could weather the storm much better than many private businesses. But equally, people were quite scared to list during that time because markets were volatile. We saw some listings maybe priced too high and come down, and there's sort of potentially given people cold feet. Now that we're still heading into a sort of equally uncertain but perhaps potentially not as promising prospect, do you think that could slow the amount of companies looking to list or looking to raise? Are you worried that pipeline could remain stalled while people are anxious about the state of not the market itself, but the pricing on it, the volatility of it?
Oh, I think, just there's a couple of points in that question which I'll touch on. So firstly, choppy markets, if you like, are challenging to price, at the end of the day. And so, those make it challenging. But just coming back to a couple of the other points. So firstly, in 2020, we had 8 new companies come to market. So even through those tricky times, we had, some pretty good wins, with businesses. Now, what some of them aren't doing is necessarily coming down the sort of the IPO channel that we've, that might be most commonly sort of the most common channel to come to market. So we had a few IPOs, a couple of smaller firms. But what we're actually starting to see now is businesses looking to what we call direct list. So they're not necessarily needing to raise capital, through the period of listing, but they literally come to market. They're well funded. The balance sheets are strong. They want to give their investors the opportunity to trade and trade those securities. But what they're looking to do is position themselves for down the track, being able to access capital. So the direct listing path has been quite popular. So we had 8 in 2020. We had 9 companies come to market in 2021. So even though the period was a little bit volatile, and we saw the benefits of public markets, certainly for those that had already been listed, so that was well documented and well demonstrated, we still ended up with some pretty good success, if you like, in new companies coming through. Clearly, we'd always like more, and some businesses through the course of last year, and these are well documented, showed intentions of coming to market and then chose not to for different reasons. So, the 2 Degrees and Vocus example, they were both looking at actually coming to market, and then they suddenly realised that maybe they could be a useful business together. So, it's disappointing from our point of view, but that's economics, isn't it? It's just sort of commercial, the commercial world in action, and you're going to get a little bit of that from time to time. Looking forward, which I think is sort of what the last aspect of your question.
Yeah.
There's lots of businesses who are still thinking hard about the public markets. As I said before, it's a little bit choppy at the moment, especially with the European issues. So we'll see where the pipeline. Talk to the team about what's on the go and who's actually considering it. And it doesn't necessarily need to be just companies. It can be people who are looking to raise fixed income securities or fund managers looking to come to market, create that sort of broader distribution. The pipeline still looks pretty healthy, but you do end up, needing to manage that through, different cycles. And admittedly, at the moment, it is a little bit choppy, so it's a little harder right now.
Yeah, cool. Awesome. Hey, I believe there's quite a lot of questions from the viewers who are the ones we're all here for. So I reckon we should cut straight to jumping into some of those if you are happy with that.
Yeah.
So the first question we got earlier in the week was who has access to pre-market and pre-close trading? Can Sharesies get access to these? Sharesies have said it's not something they currently offer access to, but it is something they're looking at. But questions for you, Mark. What do we have here? What do we got? Can you, I think you can answer this. Can you explain why share prices seem to go down when a company is paying a dividend? Why does a share price change when a dividend gets paid?
Well, prices are a judgment call, if you like, from the buyers and the sellers of that stock, and they will look at a range of things, for a business. So they'll look at the business fundamentals, which would be, what their growth opportunities are, how they're capitalizing on that, what their earnings track is looking like. And the strategy of the business, and then they'll also overlay, no doubt, the sort of the economic environment and that sort of macro sort of position. And if somebody feels that a macro position might be a little bit negative for the forward track of a business, they might be looking to, they may look to sort of take, a lower position, if you like. And if they saw a price that they thought they're happy to sell at, then maybe they would choose to do that. And that might be lower than what it's trading at the moment. So, everybody's got different views as well, and that's the beauty of a market, and especially when we've now got lots of views from the likes of Sharesies coming to play. Quite often also what happens is when somebody puts a sell order in, some people might be happy to sell it at a certain price, some people might be happy to sell at a lower price, and then it's just a question of sort of how those orders match. But I think probably the fundamental point is people will take views on businesses, people will take a view on the environment around them, they'll take a view on the sector and the prospects of the sector, and all of that will go into the decisioning of what somebody's prepared to sell at.
Of course. The other thing, of course, when paying a dividend, we sometimes call that going ex-div, where the money has literally been paid to shareholders. So the company has slightly less money. So sometimes the share price will immediately drop proportional to the amount of money they've just paid in a dividend because they're holding that much less cash, which I think might also be what Sandy is asking.
Oh, if they're looking to look at some of those technical pieces, you have a right to a dividend to a certain point, and then obviously when the dividend is paid, then you don't have that right, or you might have the right to the dividend in 6 months' time. And that's a classic time value of money concept. So if you buy the stock, just before the dividend is paid, the person who's selling it will want to, effectively want a little slice of that dividend. And they'll factor that into the price. Once it's paid, then obviously you've got to wait a bit longer.
Cool. Another question about dividends, specifically with the NZX. Jason asks, why is the NZX paying a dividend while also raising money? If it needs to raise capital, why is it also paying out capital to shareholders?
Yeah, well, there's a couple of different ways of managing the balance sheet. So the purpose of our capital raise recently was to pay for the acquisitions that we made. So we bought a book of business off ASB, the ASB Superannuation Master Trust, and we bought that for $25 million. And we paid for that because we needed to, we financed that with debt. And then also we announced at the time of our annual results that we were going to buy a slice of GDT. And we're also going to put a capital contribution in for that as well. So that totaled just over, was 12.5 million plus another 3 and a bit. So nearly 16 million. Now, an exchange is a business that you want to have a very, very strong balance sheet. So there's a lot of exchanges around the world that have no debt. And some of them are actually are net cash, if you like, on their balance sheet. And our board is a pretty conservative board. So we wanted to make sure that, notwithstanding the fact that we wanted to acquire and grow, we also wanted to make sure the balance sheet remains sound. So we the money gearing position back to the levels that we had prior to that acquisition of the ASB Master Trust business. The dividend piece is more of a long term. We took a much longer term view on all of that. Although what you might have noticed is that we paused the dividend reinvestment plan when we went through the capital raise. So we didn't obviously allow people to actually take stock instead of cash through the dividend process, because that didn't make a whole lot of sense. So we acted on that piece, but we were certainly very happy for those that have been with us, to reward those shareholders with the returns that we made.
Yeah. Is there a sense there that the company has sort of like providing a dividend each year is good for the company? You've sort of promised that in a way to shareholders, and you hold through, you carry on doing that even if you're raising capital?
Yeah, well, certainly, there's two ways to fund things. You can retain those earnings and use those earnings, or you can tap the market. In this particular instance, we had a purpose for the capital raise, but we also wanted to maintain, the dividend on the way through, because to some extent there's a bit of expectation around that as well.
Mm-hmm. Cool. Hey, Jason asks, what are the top risks NZX is seeing for its business effectively this year? What are the top risks facing the NZX that you are keeping an eye on and, I guess, mitigating?
Yeah, and that's a really good question. So, when you look out, obviously, from a business performance perspective, the markets and the volatility of the markets is something that we watch carefully, because that, can impact our earnings. So we need to be conscious of all of that. At a very practical level, when we think about risks, we manage the balance sheet very closely. Hence the comments I made around the capital raise. We also manage our technology platforms really, really closely. Because obviously, the business doesn't really operate unless the platforms are operating, every working day. So we've got to make sure that's happened. We've got to protect them, from a security point of view. Cyber is an enormous issue, and we had, everybody's probably familiar with the hassles that we had back in 2020, and we're well through that, and we've invested a lot subsequent to that. But that keeping up with the cyber risks is a huge thing. We've got a clearinghouse, which needs to perform the function of the settlement of the market. So we need to make sure that is risk managed, that all the margining of those securities is accurate and it's efficient for the market, and then we perform all of those functions. So you've got some macro factors, you've got some operational factors, and you've got some, let's call it sort of, pure financial risk management activity as well.
Mm-hmm. One question that relates to the technology and sort of cybersecurity aspect. So someone asks, are you afraid of Russian hacker attacks? Or are you prepared with improved security? Obviously, with the Ukraine crisis, one way Russia has been hitting back at sanctioning countries is with cyber attacks. NZX did go down to a cyber attack a couple of years ago. How are you assessing that risk? Is that something you're worried about at all?
I think cyber is one of those things that you're just constantly worried about now, and the world is on notice, I guess, that some of the repercussions of supporting Ukraine could be back out through cyber attacks, and there are agencies in New Zealand and also globally that are warning all sorts of organisations, not just the likes of ours, but large corporates, government agencies, just about anybody, that there is heightened risk around this area. But I think what we learned, we thought we were in pretty good position, back in August 2020, but we were not, at the end of the day. So the work that went in to shore up our security, to really lift the level of capacity with which we could defend a DDoS attack, was enormous. We've gone to some of the very best organisations in the world to provide those services for us. And then, the other aspect to it too is these phishing attacks. So, the emails that might get to, might be sent to staff, and, the education that we've gone to for our staff to make sure they don't click on links, the tools and tool sets to, strip links out that come into the organisation that might be sensing to be a little bit dangerous, and then also the software that we have to detect any unsavoury activity inside our networks. We've taken that to a completely different level. So we think we've done all of the right things, but it's a constant piece of work for us.
A bit of a cat and mouse game. Whack-a-mole, I've heard it described as. You cover one.
You don't even want to be sort of on the end of anything. So it is all about being ahead of it all of the time, and that's challenging. That's really challenging. But all organisations are in that position, and there's a lot of discussion between the information security experts across the financial services sector, for example. There's a lot of, nobody wins in this area from holding back information, so there's a lot of sharing that goes on.
Yeah. Hey, another question that's come through. What's the criteria for a company to be listed on the NZX or be accepted onto the NZX? And how much do companies spend on average to do the groundwork required to get listed? That's a good question. You don't actually have to be a very big business. I think our minimum market cap is trivial, like it's sort of 5 to 10 million. But there's a size aspect to it. There's also a shareholder spread element to it as well. So I think you need 100 different shareholders. But the reason for that is because you don't want to come and be listed and then not have any liquidity. So you've got a size piece, you've got a spread piece, and then there's certain requirements around governance, independent directors, etc. You've got to have sort of corporate structures in place that are going to be able to assist you with the management of the risk, and
then obviously the requirement to satisfy continuous disclosure is there as well. And there's certain requirements around audited financial statements, etc. So, there's a package of items there. But, most of those things, especially for larger businesses, most well-run businesses do that already. Some might not be quite as mature, but most of those things are just generally really good business practice. But in terms of getting ready for it, a business might need to assess itself across each of those areas. It might need to get ready. It might need to hire some people that are familiar with the public markets, because you really do want some experience in your management team. You might have to put in place the risk management frameworks and certainly the continuous disclosure frameworks. And then you need some help from some law firms and some accounting firms to get through the process. If you are raising capital at the time, you obviously got an issue of prospectus, and it's a really critical document. It's an important document, and that will require the support of investment banking teams and legal teams. But it could cost you $500,000. It might cost you a bit more. It could cost you $1 million to get listed. Then I get, that's just on the corporate advice side. If you're actually using an investment bank and then obviously distributing stock, then you end up paying for those services, and you pay brokerage on that distribution as well. So, it could be that you spend, somewhere between 2 and 3% of the amount of capital raised, to get listed. After you've done that, it's not so bad, basically. So you can see it as an investment in the future, and you do that obviously to have access to capital, or have the right to have access to capital later.
Yeah, and often companies that are raising capital will raise enough capital to cover their listing costs as well as something.
Correct.
So, yeah. And as you say, the price varies a lot based on how much capital you may or may not be raising. One question, which I think is inspired by those 80s style TV shots of the great crash, is can people watch the trading floor, or is that an old wives' tale you just see in movies? Is there a literal trading floor you can go watch people shout into phones at?
No, you can't now, actually. I mean, if you came into our office here, our office looks a little bit like most offices. There's an operational team, there's a technology team. We've got a lot of screens on the wall, which is really monitoring all our systems and making sure that everything's humming, shall we say. We've got a team of regulatory folk. Part of that team are there's probably half a dozen people who survey the market, so they're watching the market. So they might be ones which are watching all of the trading, and then talking back to the participants on some activity that they might be looking at. If you go into a broking firm, generally you would have a trading desk. You might even have two. You might have a retail trading desk and a wholesale trading desk, and those people are typically ones where, if you looked at any dealing room, whether it's in a bank or a broking firm, there's lots of screens and generally headsets everywhere, and there's lots of activity on phones. But the olden days of a pit and people with two phones to both ears and a person writing chalk on the blackboard, I'm afraid it's actually disappeared.
Yeah, long gone. I think we are coming up near the end of our time, but maybe we have time for one more question. And somebody asks, it looks like the NZX is about to lose another top 50 company in the form of Z Energy, which is it has a takeover bid from Ampol. Would it be a concern for the NZX to lose such a large business worth sort of $2 billion-ish?
Yeah, well, nobody likes that idea. I think, what I think a lot of the capital markets, ourselves and the capital markets ecosystem are hoping for is that Ampol might list over here as well. So, we'll see where we get to on all of that. But, you do end up with cycles. We do end up with businesses that are bought and sold, and they come and go from time to time. We obviously want to make sure that there is more coming rather than going. And, but at the end of the day, you can't stop business working. It is the way it is. But if we can end up with Ampol, on our boards here with a secondary listing, then that would be fantastic as well.
It'll be good news, yeah. And it does happen in reverse, I suppose. I believe Tourism Holdings is trying to take over Apollo, which I think is ASX listed. So technically, if that deal goes ahead, we might be pulling one onto our side.
And all of a sudden these businesses, grow in size. Their market cap changes, the number of shareholders that they have changes, the trading activity changes. So, there's lots of moving parts, lots of pieces to the puzzle. But we just want to be net growers at the end of the day.
Yeah. Awesome. Hey, Mark, we really appreciate you coming on and talking to us. I think we're probably running out of time now, but it's been great to hear from you. And I'm sure everyone at Sharesies is a very big fan of the financial markets, because otherwise why would we be here? So thanks for all your work.
No, a pleasure. Thank you, Dan. And certainly for those that listened, really appreciate people taking the time.
Brilliant. Thanks. Hey, thanks for tuning in, everyone. And obviously a very special thanks to Mark Peterson for joining us. Please check out Sharesies' daily financial news podcast called Recap. It's about 10 minutes long, published at 5 p.m. Monday to Friday on Spotify, Apple Podcasts, and Google Podcasts. It's really good, really quick, really fun, and tells you just like what happened today. I rely on it a bit, and it's my job to know what happens in the markets. So we'll see you back here on Thursday for another shared lunch. My colleague, Francis Cook, will be joined by Chris Meehan. He's the CEO of Winton Land Limited. Winton is a large-scale property developer, which is quite newly listed. It only joined the NZX in December last year. And Chris will be talking about the company, its own strategy and goals, and the process of going through a listing and its future plans. So if you want to know more about getting on the NZX and the path the companies take there, this will be a good one for you to tune into. Obviously, Chris Meehan will be taking your questions as usual. Enjoy the rest of your week and stay safe.